So in the last video, we took a look at calculating the break-even point for Digital Phone Company. And then we looked at what if 20,000 phones were sold. And then we did a sensitivity analysis by looking at if commission was increased, commission per unit, and it resulted in a 12% increase in unit sales, we came up with a higher net income than we had under the original scenario. So now let's look at D. It says refer to the original data, and what we mean by that is this data here. And it says if a $25,000 increase in advertising costs, so advertising costs are a fixed expense, okay, yields a 7% increase in unit sales, what will the new net operating income be? So in this case, we're going back to the $45 variable cost per unit. So let's take a look at it. So we're saying that we expect unit sales to increase by 7% under this scenario. So we take our 20,000 times 107%, or 1.07 times $75. And we get sales of 1,605,000. So we can see it's less than scenario C, but the question is, will the contribution margin and the fixed expenses be higher? We know the fixed expenses will be, because we're adding that 25,000. So our variable expenses now would also be 20,000 times the 1.07, or 107%. And now we're back to the $45. Remember, we did $46.50 when we did scenario C. And we get 963,000. So under this scenario, our contribution margin is higher than it is in scenario C. The only difficulty here is that our fixed expenses are higher. So we're probably going to end up with lower net income. So we had fixed expenses of 260, but we added 25 in advertising costs. So that's going to bring our fixed expenses up to 285. Our net income is going to be 57. So a little bit less, still better than the original situation. Okay. However, C is obviously the best alternative. So E says refer to D, what is the break-even point in units and sales? So again, our break-even point is going to be higher than the original, right? Because our fixed expenses are higher. So we're going to take now our fixed expenses of 285,000 divided by our contribution margin of 30, right? And we're going to get 9,500 units. So we're going to have to sell more than we did before. Here we had to sell 650. Now we're going to have to sell 9,500 units times $75 per unit, 712,500. So with fixed expenses higher, we got to sell more. Okay. So F says, of all the alternatives given, which is the best based on quantitative data only, and that's all we have here. We're going to see in subsequent chapters, sometimes we have qualitative data, or data that is non-numerical that influences our decisions. Right now, we only have quantitative data, or numbers data. So C is the best alternative. Why? Because it provides the highest net income. So that's an example of sensitivity analysis. Thank you for your attention.